Hi there, this is Mike Larson again, coming to you from the Money Show in Philadelphia. I've got Rick Bensignor, president of In the Know Trader. Rick, in our last segment we talked a lot about the S&P 500, what the sort of the broad stock market's doing, but obviously investors care about other asset classes too.
Sure.
So can you tell me a little bit about what your work says for, say, the gold market or the interest rate markets?
Sure. So, as everyone knows, gold broke out this summer from a 6-year range, kind of broke above 1375. We had been long, we had clients long since 1295 back in March, and we targeted 1487 to 1532 as the initial target of this move, and we got out on the lower end of that at about 1491.
Okay.
Gold got a little above 1550, but it's, last month's been tough for gold, and it's pulled back. And even today, we tucked under 1500. We got down to, I think, 1493. It's probably about 1505 right now. In the bigger picture, gold should still trade higher, because even if you take the $325 range that it had traded in for years, roughly $1050 on the bottom and $1375 on the top, it's $325. When you have that long of a range sideways and you break out, you'd assume the $325 range you could add to itself, which is a target of $1,700 over time. So I'd say gold still is bullish over time. The problem was, and it has been for several weeks, is that so many speculators were on the long side. If you look at the Commitment of Traders report, it was all heavily skewed towards funds, commodity funds, and speculators on the long side, and the trade in the industry, what we call natural hedgers, were on the short side. There's only so far that can go before usually speculators have to reduce position.
Sure.
So we've seen a couple of decent sell-offs now. Gold has not cracked, though. The low of the move, I think, since making all-time high was maybe 1488.
Okay.
So it hasn't really broken down. But in general, I still like gold. I think people need to have some position in the gold market. Don't worry about the day-to-day fluctuations. One day this week we're down $30 in gold.
Yeah.
And then the next day we got 15 back. So, but you want to have some exposure to gold. And for most investors, the easiest way to do that is through the ETF GLD.
Sure.
There are other ETFs, and certainly you can have futures contracts, but then you have to roll them over.
Yeah.
So the easiest way to get exposure is just pick an ETF that tracks the price of gold.
Okay. Now, there's so much talk these days about what's the Fed going to do? Are they going to cut? Are they not going to cut? What is the impact of lower interest rates on stocks? So what does your work show for the interest rate markets? I mean, where do you see things going there?
So we got down several weeks ago, we got to 1.45%, which is, if that holds as a low, we'd really have a triple bottom going all the way back to 2012. So if you use 1.4% for the US 10-year, plus or minus 10 basis points, you've now got 3 different times we've gone down there. Now, we haven't spent enough time above the 145 now to clearly define it as a low. But I actually think between now and year's end, we will not revisit that low at 1.45. So we've actually been having clients sell bonds. We went to 1.9, which was exactly where we thought. We've pulled back. We're hanging around 1.7, again, plus or minus 5 basis points. And there's an ETF that you can buy that is the exact opposite of owning either IEF or TLT, which is what most people own to get long exposure in bond. So this is an inverse one, and it's not leveraged, so it's a 1-to-1 ratio. If I remember, the ticker is TBF, like Frank.
Yeah.
And when you buy that, you're actually it's the essential same as being short bonds. So it will go up in value as interest rates go up. So we're actually got a position in that now.
Okay.
And I think we'll retest 1.9 and even get as high as 2.07.
Okay. One last thing that I guess would pertain to stocks is sort of with the behavioral finance work that you do. Is there a particular sector, group of stocks that you think people should be avoiding at this time versus maybe what they should be focusing on?
The defensive side of the market still has some bid to it. REITs have come in, but they're still one of the best leaders this year. Staples have gotten some. Anytime there's the thing now is because you've got a president who tweets at 2 a.m.
Sure.
So headlines come out all the time, and the market is reacting to these. Even the algorithms read these headlines and just move the markets. Yep. The S&P moves 20 points in 2 minutes when a headline comes out. So by the time you've read the headline, the move's already happened. You don't even know what to do anymore.
Sure.
Tech is weakening, but in general, I like tech.
Okay.
It's the growth part of the market. Some people even advocate that technology should replace, or even you put it, semiconductors should replace transportation stocks in Dow theory. So you should have industrials, because transportation stocks are no longer what they meant 100 years ago to distribute product. So tech, I think you just have to have exposure to. Financials are going to be very sensitive to where the 10-year is now. So, if we cut rates, it's not going to be good for them. If you can see any day that banks are moving up, it's because interest rates are moving up. And the other stuff is kind of middle of the pack. Healthcare has been the big dog of the year. It continues to be. Energy's gotten a little bit. We actually, for the first time this year, just got a little exposure into energy, which is something we have avoided all the way until September.
Got it. It's a great nugget there. We're almost out of time, so I guess before we wrap things up, would you be able to just tell the viewers where it is they can get more information about what it is you do and sign up? Thanks,
Mike. So go to intheknowtrader.com and you'll find lots of videos and information about what I've done, behavioral finance, interviews I've done across TV and other places that do interviews. And there's also information about our newsletter. We've got a very reasonable price for a retail newsletter that's giving you institutional quality research. So check that out, intheknowtrader.com.
Great, that's In the Know Trader, everyone. Thank you for your time. And Rick, thank you.
Thanks, Mike.